Time now for your bond update, and the rush that we've seen into bonds continues uninterrupted. For more now, let's turn to Bloomberg's Lisa Abramowicz. Lisa.
Scarlett, I want to take a look at some of the tallies in the bond market when it comes to fund flows. Let's take a look first at week-to-date ETF flows. You can see really the high-yield bond ETF, HYG, seeing the biggest gains with more than $1 billion of inflows, followed, interestingly enough, by longer-term treasuries. And again, J&K is another high-yield bond ETF. Sort of interesting that you see the flood of cash into both the riskiest debt as well as the safest debt. And this really follows a theme that we've seen throughout the year. Flip up the boards and take a look at some year-to-date data by Bank of America, Merrill Lynch, and EPFR. You can see that investment-grade credit, safer corporate debt, has seen $146.5 billion of inflows year-to-date. This is just U.S. funds. Meanwhile, emerging markets coming in second, high yield. These are much smaller asset classes, so the totals are smaller. And then loans, which is a floating rate asset class, seeing outflows, continuing that trend where investors are looking for duration. They're looking for that bet on rates going lower, as well as credit quality not deteriorating too much. But it really raises a question, Scarlett and Caroline, how much longer this can continue, where we see a rally in both safe debt as well as risky debt. At what point is this contradictory? And this is a question that we're going to face over the next few months through 2019.